Good afternoon. Market news now. Stocks rose in the wake of reassuring comments on monetary policy tightening from Federal Reserve Chair Jerome Powell, while crude oil extended gains sparked by Russia's invasion of Ukraine. Japan spurred a climb in an Asian share index, while European and U.S. futures were steady in the slipstream of broad rallies from the S&P 500 and the NASDAQ. And of course, locally, we saw Exxaro, which is the largest supplier of coal to Eskom, saying that buoyant commodity prices helped lift profits by more than half in its 2021 financial year, even as problems on South Africa's rail network weighed on its production and exports. The company's coal production volumes fell by 10% last year and exports by more than a third as South African miners battle with locomotive shortage stemming from vandalism and cable theft. But to give us perspective in terms of a global perspective, we are joined by Han Tan, who is from Xfinity. Han, thank you so much for your time. I mean, yesterday we had Fed Chair Jerome Powell, testifying in front of the House committee, and the market was reassured by his comments. And what was quite interesting is that when it comes to the idea of a 50 basis point hike, he said that, he's not opening the door for it. It could be in a particular meeting or over a series of meetings in order to stem inflation. What did you make of some of the comments, he uttered at that committee meeting?
Yeah, overall, it appeared to be relatively dovish, right? At least compared to some of the market projections that were evident about 3-4 weeks ago, whereby markets had already braced for that 50 basis point hike. Now, granted, this was before the Ukraine crisis. So now with Powell throwing his weight behind that 25 basis point hike for this month, we saw the reaction in the markets, U.S. stocks taking some relief there, knowing that perhaps the Fed will stick to its more gradual approach in its battle against inflation.
The one thing that I'm wondering is whether markets are factoring, the possibility that we could have slowing growth and high inflation at the same time.
And the short answer to that is yes, Anastasia, because if you look at the yield curves, they have been flattening, be it the spread between the 2 and the 10s or the spread between the 5 and the 30s. Those are U.S. Treasuries there. And also the idea is that markets are indeed bracing for a potential stagflationary environment, right? And that's despite the Fed's plans to hike interest rates. There have been a lot of criticisms saying that the tools that the Fed has at their disposal at this point in time is not well suited for the kind of sources for inflation that we're seeing right now. And on top of that, you have the shockwaves from the Ukraine crisis, of course, that amplifies the possibility of a policy error by the Fed, right? So that's why you've got the Fed funds futures pointing to fewer rate hikes this year, now down to 5 compared to the 6 that they had been penciling in just a few weeks ago.
What has been interesting for you when you look at some of the performances of the safe haven assets, at least over the past month?
Yeah, perhaps not surprising, but a reminder that gold has outperformed some of these other safe havens, right? Because keep in mind, coming into this year, the expectation, or at least my expectation, was that gold would have a tough time trying to battle against the rise in real yields in anticipation of those Fed rate hikes that we mentioned earlier. But you see gold bulls being able to shrug those off and just climb higher. And of course, they have been feeding off the fears from the Ukraine crisis. But overall, we certainly see this risk aversion being this tide that lifted all safe havens, and that includes the Japanese yen, the Swiss franc, and of course the US dollar, granted to varying degrees.
On that note, then, what can we take away when we look at the performance of European bonds versus U.S. bond yields?
Yeah, the fact that German bonds, the yields went back down into negative territory, although now as we speak, it's back up in positive territory just slightly. And while U.S. Treasury yields, on the other hand, are still firmly in positive territory. So we are seeing this healthier spread between what's happening on the continent versus what's happening on the States, in the States. And that's why we're seeing this stronger US dollar versus the euro. And I think all that is symbolic of the kind of policy outlooks for the Fed versus the ECB. The idea that with the security crisis at the ECB's front door, it ramps up the possibility of a policy error for the ECB more so than the Fed. And so this divergence that's playing out in the policy outlooks is feeding into the currency markets, is also reflective of what's happening in the yield space.
What do you believe to be the biggest risk for markets right now if geopolitical tensions continue?
Indeed. So obviously the one that's front and center is the concerns over inflation, right? We have seen oil prices just reach fresh multi-year highs, levels that we haven't seen since 2014. So, with that kind of pressure on already scarce commodity supplies, it ramps up inflationary pressures, and that really leaves these central bankers, be it the ECB, the BOE, the Fed, on the back foot, given that they are already perceived to be behind the curve in fighting inflation, right? So I think that is front and center of the market's minds, and of course the geopolitical tensions just lend itself to this risk-off mode that we have been seeing play out in the markets really for a few weeks now.
Han, what are you keeping an eye on in terms of events before I let you go?
Yeah, also, of course, like I've mentioned, the Ukraine crisis and developments there will be the primary driver, at least for the immediate term. But if you look at the economic calendar, tomorrow we've got non-farm payrolls, and then next week we've got the next set of U.S. inflation data. Looking at market forecasts, that's set to be at the highest since 1982, a fresh 40-year high. So I think these data points will be a reminder for global investors that, hey, the concerns that you had coming into this year about the Fed's tightening, policy tightening, that's not gone away, right? But just now you have this added pressure from what's happening in Eastern Europe.
Han, let's leave it there. Thank you so much for your time. That is Han Tan, who is a chief market strategist at Xfinity, talking to us about what he's seeing from a global perspective. We'll have more business news after the break, including the financial results of FNB, so stay tuned.